Hello, this podcast will be looking at the IA2 extended response and how to maximize your planning time. Now, your extended response will be looking at classifying and analyzing one of two ratios, that being liquidity ratio and also the profitability ratio. Now, your assessment piece will guide you which ratios you need to analyze and interpret. You will not be required to do both the liquidity and the profitability. So looking at the liquidity, they are four main ratios here, that being the accounts receivable turnover, the inventory turnover ratio, the quick asset ratio, and also the current ratio. Now, the quick asset ratio and current ratio can be analysed concurrently because they're looking at very similar data. In terms of profitability, you're looking at a gross profit ratio, the net profit ratio, return on owner's equity, and return on total assets. Now, in saying that, each of those ratios will give rise to a number of key issues. So there are three key issues here. There may be a decrease in profitability, decrease in cash and liquidity, okay, and also a lack of managerial policy and analysis. So we're looking at here the accounts receivable policy having issues, and also the inventory turnover not meeting the target market in terms of its advertising and also the types of products that you might be selling. So these here will form your headings in terms of your report. For today's podcast, we are looking at the profitability ratios, that being the gross profit, net profit, and return on owner's equity and return on total assets. Now, in saying that, what I've got in here is a infographic on which accounts and ratios affect the net profit ratio, and I also have here, which I'll be flipping between the screens, a statement of profit or loss and a statement of financial position. Now, I've tried to color code each of these according to the issues. Okay, so if we skip back to the infographic, we can see here the net profit ratio is in green, and your statements have green in here as well. Your gross profit ratio is in orange, and likewise they'll be highlighted in orange, the key accounts and ratios, and the net profit return on total assets ratio will be in blue. So firstly, looking at the net profit ratio. Now, the net profit ratio is basically a ratio which looks at how much profit is being derived from the sales. So you want this ratio to be high as possible. Now, the accounts that affect the net profit ratio are the interest on your loans, your wages, okay, and also your bad debts. So looking at your statement of profit or loss, we've got these in green, so the bad debts here, interest of loan, and also your wages. Now, these wages are the office wages, not the actual sales staff wages. Now, using this infographic, you can see here when you're in planning, you might have two or three highlighters, and you'll use one highlight to highlight on your statement of financial position and statement of profit and loss these three accounts. Now, what the net profit ratio is affected by on the statement of financial position are two main accounts, that being inventories and accounts receivable. These two main accounts will also affect the gross profit. So I've highlighted that in green to start off with. So your net profit ratio here will be your bank, and also we can see here that this bank account has gone into overdraft, which is not good, so I'll highlight that in green. This basically signifies that we are not making enough profit to meet the day-to-day operations of the business, but also expanding the business as well in terms of purchasing of assets. Now, the net profit ratio, if it's decreasing, will have a negative effect on two ratios, that being return on total assets and also the return on owner's equity. So if this ratio is decreasing, more than likely these two are decreasing as well. Now, as part of your writing of your responses, you need to highlight key negative relationships. The issues and the explanation of the trends will be done in a further podcast. The negative relationships of having a decrease in net profit will give rise to a decrease in cash at bank, which we have seen here. The cash at bank has gone from having $2,200 in the bank down to a negative $10,000. The net profit ratio will also impact the current and quick asset ratio as well. So if we can see here down the bottom in this key data here, the current ratio has gone from 3.1 to 1.39. The quick asset ratio has gone from 1.16 to 2.84. These need to be as high as possible. In particular, the quick asset ratio be around 1 to 1 and the current ratio being around 2 to 1. So we can see here the profitability has reduced the cash at bank, which has created a bank overdraft, which has therefore decreased the current and quick asset ratio as well. Now also you'll see a negative or decrease in return on owner's equity percentage and also the return on total assets percentage, as we can see here. The return on equity percentage basically has gone from 10% all the way down to about 8%, and the return on total assets ratio has gone from 12% down to 7%. That basically means that the sales that we are generating is not meeting to have a strong investment or a strong return for the owner. So therefore he or she might look at investing elsewhere, but also because of the decrease in net profit, assets are not being fully utilized as well. Okay, moving on to our next ratio, that being the gross profit ratio. Now, the gross profit and net profit ratio are very close and very similar in terms of what it actually affects. So in terms of the gross profit ratio, these are the four main accounts that affect this account. Obviously, the sales, salary, wages. So if our floor staff are not earning enough or generating enough sales, our gross profit and our sales will actually go down. If our advertising is not meeting the right target market in terms of what they look for our products and services, our sales will go down as well. Conversely, if we're paying too much in our stock and inventory, that'll have a negative effect on our gross profit. Or if our sales are declining because of our advertising and wages and sales are not meeting the required amount, our sales will drop as well. So I've highlighted these over here on the statement of profit or loss as orange. So our sales have dropped. Our sales increased from 275 to 318. However, we've had a huge markup in our cost of sales. Our salaries or wages have gone up as well, and our advertising and promotion has gone up. So we would look at whether the increase in this advertising has a positive effect on our sales, okay, and also whether an increase in our wages and salaries has had a positive increase in our sales. So you look to have these percentages be smaller than the increase in sales. If not, you'd be looking at whether this increase in wages has had a positive effect, along with the advertising and information has had a positive effect on our sales. If you look also on the statement of financial position, these two key relate to our gross profit as well. So our inventories have gone down from 20,000. However, our accounts receivable has gone up by about 9,000. So our credit sales have gone up, but you would need to look at when viewing the accounts receivable turnover whether our ratio has gone up in terms of amounts outstanding, which will have a negative effect on our cash flow. Those will be discussed in further podcasts when looking at these ratios itself. Okay, now the gross profit will have a negative relationship on the following things as I discussed. Inventories. If we're not earning enough money from our sales, our cash at bank will go down, and that's obviously been the case. We need to look at our credit sales. In this case, our accounts receivable has gone up, which means we would have more credit sales, which we have here. Okay, that can be a good thing. Our sales have increased by that much, but you need to look at whether these accounts receivable in generating that credit sales will actually pay their amounts in time, and that will be reflected in the accounts receivable turnover ratio. You also need to look at, if you are given a cash flow statement, whether our receipts from our customers in our cash flow statements have gone up or down. If it's gone down, that will signify that we're not actually generating enough cash from our sales, and a lot of our sales is getting caught up in our accounts receivable, and they are not actually paying on time. You'll also notice if our net profit and our gross profit ratio is decreasing, that our current and quick ratio will go down as well. And as you can see, they actually are. Now, our turnover ratio here for our accounts receivable has gone up from 66 to 74 days, which is bad for the business, which will have a negative effect on our cash flow statement. And you can see here our quick asset ratio has also decreased, which is not a good sign for the business as well. Now, our return on total assets is basically looking at how effectively we are using our assets to generate sales. So in terms of the return on asset ratio, there's two key accounts here, our depreciation expense and also our sales. Now, if we're using our assets effectively, sales will go up, and if we have brought on more assets from the statement of financial position, you'll see our depreciation gone up as well in our statement of profit or loss. As you can see here, our depreciation from furniture has doubled, which basically means that we have spent money on buying more furniture. So you would hope that furniture has been used to good effect to generate more sales. And you can see here that our furniture has gone up from 13,000 to 27,250. And you have to wonder and ask, how can the business afford this increase, and where have we got that money from? Considering our net profit has gone down from 40 to 24,300, you can see here that we've used all of our bank account and are now in a bad position where we actually owe the bank money. Other accounts that you might want to look at to determine where the increase in the purchase of the assets are from, you would be looking at your mortgages and also your loans. Okay. Now, having a bad or a decrease in return on assets ratio will affect our return on owner's equity, okay, because we're not deriving enough profit. This will also have, you would look at having a look at the cash flow statement for the cash flow for investing activities and look at whether our purchasing of assets have gone up. And in this case, it has doubled, as previously stated. We can see here our assets have gone, in particular furniture, have doubled. So this is a good time in which to actually use your 15 minutes to try and determine what's going on with our ratios and how those ratios are actually affected. Our next podcast will be looking at the liquidity ratios. So in particular, the current asset, the quick asset ratio, and also the inventory turnover and accounts receivable turnover.